depending on where you are around the country. Welcome to a perspective on 401k issues and pitfalls for 2013. As you may know, 2012 has provided us with a few changes with regards to the retirement plan space. As such, this webinar is intended to give some powerful insight into the legislative changes, some of the hot points that we're seeing from the Department of Labor and the Internal Revenue Service, as well as provide some feedback from our peers, as well as some industry leaders here that I'll be mentioning in a second. We have three speakers today that will be discussing three very pertinent matters with regards to the retirement plan space. Our first speaker today is Marcia Wagner. She is the Managing Director of the Wagner Law Group, one of the nation's largest boutique firms specializing in ERISA, employee benefits, and executive compensation matters. She will be discussing the impact of the 408(b)(2) rule that came into effect in 2012, specifically July 1st, 2012. Those of us on the call that understand and have heard of that rule change, it's pretty important for us to go through it, and that's why Marcia will be talking a little bit about that, as well as some of the different types of advisors that you may see out there for your guys' plans. Our second speaker is Greg Klein, CPA and partner with Miller, Kaplan, and Arate. With his 25 years experience in the public accounting space, Greg serves as one of Miller Kaplan's primary 401k plan audit partners. He helps with clients comply with their annual benefit plan audit requirements and assisting with navigating the technical complexities of operating a qualified plan. Many of us on the line know that that can be quite intricate at some points, and he'll be discussing some plan operational and hot button issues that many plan sponsors go through. I will be coming on after those two, going over some items regarding on the 338 fiduciary role and how that impacts plan sponsors. Again, my name is Brad Bear with One Capital. Our focus really is to help individuals protect, grow, and distribute their wealth per their most personal objectives. With our expansion now into the retirement plan market, we remain focused on comprehending the financial goals and challenges and values and motivations of all our individual investors, but even now into the retirement plan participants, as well as helping the retirement plan sponsors. With that being said, I will let Marcia start with going through the items of 338, 320 fiduciaries, as well as the DOL rule changes. So Marcia, please. Marcia, are you there? Well, for some reason there, we're having a little technical issue with Marcia, but as we go through here, we'll go ahead and skip right along to Greg Klein, and he'll be talking again about the plan operational issues and hot buttons here with regards to how it impacts plan sponsors and what we're seeing from the Department of Labor Internal Revenue Code. So Greg, go for it.
Thank you, Brad, and good morning, everybody. Thank you for joining us. At Miller Kaplan, we work annually with approximately 300 401k plans, performing financial statement audits for these plans and helping them fulfill their annual Form 5500 filing requirement. As such, this puts us in a unique position to gain perspective to see the common issues and problems that are being experienced by a wide array of 401k plans. And please keep in mind that our 401k plan clients range the gamut from smaller companies sponsoring 401k plans who may have just over the 100 participant filing threshold or audit requirement threshold, all the way up to Fortune 500 and public company 401k plans with thousands of participants. So these are not just, and as well, across a wide array of industry sectors. So these are not issues that are just affecting smaller plans or larger plans or, say, technology companies. It's across the board. So I'd like to spend a few minutes this morning talking about a couple of areas in regards to plan operations. The first area is under the transmittal of participant contributions, and talking about the Department of Labor's rules for transmitting participant contributions. This is, in the past, and continues to be, a very hot button issue for the Department of Labor. The Department of Labor's general rule states that participant 401k contributions withheld, as well as participant loan repayments withheld, must be remitted to the trustee or custodian of the plan as of the earliest date they can be reasonably segregated from the general assets of the company. However, in no event can this be later than 15 business days after the end of the month in which these amounts were withheld. However, keep in mind that the Department of Labor does not consider the 15 days to be a safe harbor. You do not get a free automatic pass if you contribute, say, the next month by the 15th day. So the key issue or question becomes, what would the DOL consider to be this reasonably segregated date? Well, upon a DOL audit, they would come in and look through your company's or plan sponsor's records and see how the company is paying its payroll tax liabilities. And the DOL's reasoning is that the plan personnel, payroll, HR folks who are transmitting the participant contributions should have the same basic information to it available that the payroll people use to transmit the payroll taxes. For example, payroll journals, payroll records, etc. Those same records should tell how much 401k contributions were withheld and loan repayments that need to be transmitted to the custodian or trustee. And therefore, the DOL would expect the employers to pay the withholding and loan repayments on the same date that it's paying its payroll taxes. Our experience from hearing about some clients' DOL audits in the past is that when the DOL has come in, they could consider anything from 2 business days to 5 or 7 business days as reasonable. But keep in mind, it all depends what the Department of Labor would deem reasonable, not what the company deems reasonable or what the boss or the president deems reasonable. It's what the Department of Labor deems reasonable. And keep in mind that if the Department of Labor pays you a visit and does an audit and establishes this reasonably segregated date, that your plan and the company must use this date on a go-forward basis forever and remit its contributions within that assigned schedule. If amounts are not paid within the regulations, these transmittals are considered late and under Department of Labor rules are considered prohibited transactions. These type of transactions can carry an excise tax of up to 15% of the amount involved, which the amount involved is the lost earnings to the participants during this time period, plus a potential 100% additional tax for each year that it's owed to the IRS. There also could be interest that's due to the IRS at current published rates, plus penalties of up to 25% of the tax for each month. I'm sorry, in total for 25%. It's 1/2 of 1% of the tax for each month that it's not paid. In addition, plans must also make participants whole with respect to lost earnings. So it's for all these reasons, including, or not mentioning rather, the administrative burden and hassle of computing and transmitting all these amounts, that we always recommend to our clients that the funds be remitted to the trustee or custodian as soon as feasible after each payroll. If the DOL comes in and does an audit, they don't like to see that the employers have held on to these monies, which are considered trust fund monies, and have instead used those monies to, say, pay vendors, pay the owners a bonus or a dividend, etc., instead of paying those monies over to the trustee or the custodian. They like to see that either the employer or plan sponsor has paid everything timely, or if not, they like to see that the employer has caught the error and been proactive and done all the things they're supposed to do, firstly, making participants whole with respect to earnings, any lost earnings during that period, and either filed the excise tax and paid the excise tax on IRS Form 5330, or filed an application under the VFCP program, that stands for Voluntary Filer Compliance Program, which can provide an exemption from the excise tax that would normally be due. When we're doing our audit test work, when we're doing our audit test work, we look at many different areas. And one of the areas is the transmittals. And if the company has not paid its transmittals timely, or what we feel is timely, we will put a comment in the letter of recommendations that we typically do at the end of every audit. We do a letter to management showing any internal control weaknesses, et cetera, that we've noted during the audit. And in such a case where, say, the company has paid within the 15-day safe harbor, but maybe not as quick as they're paying their payroll taxes, we will make a comment saying that we noted this, and during our audit, we noted that the participant contributions and loan repayments were always remitted prior to the 15-day period, but not as timely as the Department of Labor might expect. And therefore, we recommend submitting to the plan's trustee or custodian as soon as feasible after each payroll. So keep in mind when we make this comment that if there has been no DOL audit that has established this reasonably segregated date, we use our best estimate of what's reasonable. But keep in mind that DOL has the final say in what this reasonably segregated date is. Okay, let's go to the next slide. One back there. Okay, yeah, let's talk about the next area under transmittals, which is reconciling employee contributions withheld and loan repayments to the amounts shown by the trustee or custodian. And you might want to go to that our first poll. We're going to do a poll here asking you if your plan performs such reconciliations.
So this is Brad again. You will see on your screen now something that Greg is going to talk about, and something very important. So please feel free to answer, and I'll make sure to show the results here in a second so that the audience can see, you know, the importance of the transmittals and reconciliations and what Greg's going to go over. And you can see from your peers, you know, where they are and who's doing what, and then we'll be able to show some stats at the end regarding what's happening in the industry.
Right.
So I will close the poll here and share the results. What it looks like is the...
Wow, I'm surprised at this result. It's showing that 86% say yes and 14% say no. And based on the number of comments I made last year, it's probably more likely that all the clients that are on the line with us today are the ones that are performing the reconciliations, and the ones that aren't maybe felt too embarrassed and didn't sign up for today's webinar. But regardless, let's talk about some of the areas in which some of these differences can arise between the amounts that are withheld and the amounts per the trustee or custodian. Quite often, these adjustments revolve around payroll transactions. And there are various types of payroll transactions that create these differences. For example, payroll checks that are voided. Quite frequently, we see in our audits where, after the fact, a payroll check has been voided, and therefore there would be no liability associated with that. However, we see that the amount has already been transmitted to the trustee or the custodian. So the trustee or custodian would be showing more contributions than the payroll records would be in that instance. Similarly, we see where there's changes in the gross pay of an employee's payroll check, for example. Let's say in their original check they were supposed to receive $1,000 gross, and the payroll people realized that that person should have received $1,200 gross. Well, that $200 difference has a withholding difference on it as well. And that difference, that adjustment, needs to be reconciled and that extra amount transmitted to the trustee or custodian. We also quite frequently see, even though less of it these days due to automation, we see where there's data key punch errors into the payroll systems that create these differences that quite often are not corrected timely or not corrected at all. We also see with clients who have remote locations or multiple locations that the withholdings for employees at these locations are either not included at all or included at incorrect amounts. And that's typically due to the lack of resources at these remote or other locations. And one brief little horror story to share with you from last year's audits. We had a client who issued a terminating distribution to one of its participants, and that participant's terminating distribution check included quite a lot of extra money because it turns out there was about 3, I believe, voided payroll checks worth of additional contributions in this participant's account. So this participant made off with about $2,000 more than they probably should have. Keep in mind that we're talking about participant contributions, but these differences and adjustments will also most likely affect the employer matching contributions as well if your company has those. And that's because quite often the employer matching contributions are often based on and tied to and also transmitted with, quite frequently, the employee's withholdings, employee contributions. So keep that in mind as well, that the employer match would also need an adjustment. And lastly, these amounts typically trickle into the non-discrimination testing, and we see differences between all three of these, the amounts that are withheld per the payroll records, per the trustee or custodian, and per the non-discrimination testing. It's very important to perform these reconciliations so that these differences do not get out of control. Keep in mind that it's the employer or plan sponsor's responsibility to promptly identify and correct these errors that we've been talking about. Our experience is that, well, except for those on the poll this morning, many employers do not perform such reconciliation, and they just assume that the trustee or custodian's figures are correct and that there couldn't be a problem. But quite often there is problems, and the reconciliation would help us out immensely. That's why we feel it's very important for the employers and plan sponsors to be proactive in this field and do frequent, no less than, say, quarterly or at the absolute latest semi-annually, reconciliations between the amounts that were withheld for participant contributions and loan repayments per the payroll to the amounts withheld per the trustee or custodian. And for any bean counters out there amongst us who may be doing the reconciliation, on your trustee or custodian side of the reconciliation, you want to be sure to factor in any accruals that may need to be accounted for. For example, if coming up at your March 31st quarter end, you're doing the reconciliation and you take the trustee's balance as of March 31st, there may have been a March, say, 30th or 31st payroll where there has been amounts withheld, and therefore those amounts would show on the payroll side, but they haven't been transmitted to the trustee or custodian, say, till the first few days of April. So those amounts would need to be added to the trustee or custodian side. So plan sponsors or employers out there, hear my words. You want to catch and correct these errors before the Department of Labor does before an audit. The penalties would be less. There's less hassle and administrative burden, etc. So the next area I'd like to talk about is in regards to plan operational issues, and two areas under that umbrella I'd like to talk about. The first one is in the area of hardship withdrawals. Hardship withdrawals are distributions that are made to participants who are experiencing an immediate and heavy financial need. These types of hardship withdrawals we've seen are often granted without the necessary proof being submitted of financial need and proving the exhaustion of other financial resources, which are prerequisites to issuing many hardship withdrawals under many plan documents and summary plan descriptions. It's very important for plans to have a best practice or an internal control procedure that is designed to determine that an actual financial hardship exists as a precondition to granting the hardship withdrawal. The plan document and SPD should specify what constitutes an immediate and heavy financial need. Quite typically, these needs revolve around extraordinary medical expenses, expenses regarding a mortgage or a primary residence, etc. And the document should also spell out what documents need to be provided to, prove that this need exists. As part of this best practice, there should be a member of plan management that's designated and should be responsible for reviewing the necessary documentation, the applications, and the various documents, whether they be bank statements, tax returns, etc. And also be responsible for approving the application, following up on it, and as well as keeping a copy on file in case of any audits. A few horror stories we came across last year in this regard. One client we found was issuing hardship withdrawals without any proof of financial need being required, and this is what I touched on earlier. The client said, well, we thought the trustee was responsible for that, or custodian, and the people at Fidelity or whoever it was said, oh no, we don't do that. That's the employer's responsibility. So it's important for the plan sponsors and employers out there to be aware of what the terms of their plans are and who's the responsible party for reviewing these documents. We had another case where hardship withdrawals were granted to terminated participants. And under most plans, you have to be a currently employed employee to receive a hardship withdrawal. Similarly, we had another client who had some people who took hardship withdrawals, but immediately after those withdrawals, these participants were still receiving employer matching contributions. And again, under most plans, you cannot receive a matching contribution of employer funds for a period of 6 months after the hardship withdrawal. That is similar to the rule that there can't be any employee or participant contributions made to the plan for a period of 6 months after a hardship withdrawal. And let's see, there was a poll. We should, did you do the poll already?
I will be bringing up a poll here right now regarding who reviews and approves the hardship withdrawal for your plan. Is it you as the employer, the company, the plan sponsor? Is it the trustee and the custodian? Or is it I don't know? And it'd be interesting to kind of see where the peer group here is and how that works.
I'm expecting the I don't know. Based on the first poll, I'm expecting the I don't know category to be the least, the smallest bucket here. So we'll talk about that in a second.
Yeah, and actually, while they're answering that, Greg, I had a question I want to bring up, and maybe the audience is thinking about this as well.
Okay.
But regarding in-service hardship withdrawals, would that still comply with some of the consistency with the SPD or the plan document? Yeah,
as long as some of these things we talked about, that somebody has reviewed and approved the documentation, that they're a currently employed participant, and that they're aware that they're not going to be allowed to make any contributions of their own, nor will they receive employer matching contributions for 6 months after.
And again, still pertinent and still back to whatever the summary plan description or the plan document.
Exactly. The key point is that every summary plan description and plan document is different, even though they have to comply with DOL rules and get a determination letter and all that. So it's very important, again, for plan sponsors to understand what their SPD and plan document says and operate in accordance with those rules and regulations. So
we'll go ahead and show the results here of the poll we just took. So
okay, so according to the poll, it looks like about 65% it's the company's responsibility, 23% say the trustee or custodian, and 16% didn't know. So that could be an action item for some folks out there to find out, and in case the next hardship withdrawal request comes in, they'll be armed with that knowledge and know how they have to proceed on that. Okay, good. And let me go to my last issue here, which is talking about plan operations, which is dealing with the issue of compensation. We quite often see where plans are using the incorrect definition of compensation to compute the employee's 401k withholding. And quite often we see items such as commission income, bonuses or bonus income, auto allowances, and cafeteria plan or Section 125 withholding. These types of items are quite frequently spelled out in the plan document or SPD as either subject to or not subject to 401k plan withholding. And quite often we see where plans are improperly withholding or not withholding on these items. And so this can result in either ineligible deferrals being sent to the trustee or custodian, for example, where bonuses are not supposed to have 401k withholding applied to them, and instead there was, and those monies were sent to the trustee or custodian. Or it could similarly result in a shortfall in deferrals. Say if those monies should have been withheld from bonuses or commissions and they weren't, those amounts should be made up at a later time. Okay, and so now...
Well, great. Now we're going to segue back to Marshall Wagner here in a second, who's now, we're going to go through the different types of advisors from 338 fiduciary to 321, the non-fiduciary. So those plan sponsors out there, with plans and such, be thinking about the partnership role and the delegation role of your responsibility with the plan regarding its investments and such, and Marshall will be able to segue into that. But Greg, thank you for that. That was perfect. And just a note as well, any questions you guys may have, please go ahead and feel free to type it in there. We'll definitely have a Q&A at the end of this. I already see 1 or 2 questions in there, so we'll make sure to address that right after Marcia and I go through some of the different advisors. So with that, Marcia, please go ahead.
Hi, can you all hear me now?
Right? We can hear you.
Great. All right. Well, good morning, good afternoon, whatever. I was listening with great interest to you, Greg. Everything you were talking about, by the way, would adversely impact the tax-qualified status of a plan, and there are many modalities of plan rectification that can be utilized, voluntary correction and self-correction. And we're very expert in that, but the one thing you cannot do is sweep it under the carpet. These things never go away, and they become worse over time. So I urge all the listeners that if there are any either form or operational or demographic defects in their plan, documentation, or operation, that you reach out to counsel that is knowledgeable in how to proceed. Because there are ways of fixing this that frankly really aren't that painful. But that will bring me to the topic of really what I think everyone needs to know, which is an overview of ERISA. The Employee Retirement Income Security Act of 1974, or the acronym ERISA, is the federal law that regulates all tax-qualified retirement plans. Title II of ERISA includes the various requirements that a plan and its related trust must satisfy in order to qualify for favorable tax treatment under the Internal Revenue Code of 1986 as amended. Title I of ERISA includes the various requirements that plan sponsors and other plan fiduciaries must satisfy when operating the plan and managing the plan's assets. Title II is enforced by the Internal Revenue Service. Title I is enforced by the U.S. Department of Labor. As you may have heard, ERISA is a highly technical area of the law, which is why attorneys that practice ERISA really need to specialize in it. The Wagner Law Group is a boutique law firm with one of the largest ERISA practices in the country, and some of our attorneys even subspecialize within certain areas of ERISA. Next slide, please. So what are some recent developments? In terms of recent developments, there's been a great deal of activity in Title I of ERISA. The DOL recently introduced new fee disclosure rules for plans subject to ERISA. These new rules impact both service providers to plan clients as well as plan sponsors. Effective as of July 1, 2012, all covered service providers, i.e. vendors to plans, must make detailed fee disclosures reasonably in advance of being engaged in accordance with the DOL's 408(b)(2) regulations. Therefore, the responsible plan fiduciary or plan sponsor must ensure that the plan's covered service providers have delivered the requisite 408(b)(2) disclosures. Moreover, the plan sponsor or responsible plan fiduciary is under an affirmative obligation to make sure that it evaluates the fees and that in totality, given the services rendered, that the fees are reasonable. Benchmarking, by the way, would be helpful here. Providers of fiduciary services and record-keeping services are automatically covered service providers subject to these rules. Other key service providers, such as accounting firms, are only subject to these disclosure rules if they receive indirect compensation, such as revenue sharing payments through the plan's investment providers. There's also participant fee level disclosure rules, whereby employers sponsoring 401k style plans are now required to deliver fee-related and investment disclosures to plan participants in accordance with the DOL's 404A5 regulations. The 404A5 disclosures include both annual disclosures that must have commenced by August 30th of this year, of the past year, 2012, and quarterly fee disclosures that must have commenced by November 14th of 2012. The annual disclosures must include a comparative chart with a side-by-side comparison of the plan's investment options. The quarterly fee disclosures can be, and frankly often are, incorporated into the quarterly participant statements done by the record keeper. Although the plan sponsor is the fiduciary responsible for providing the 404A5 disclosures, it customarily relies on the plan's record keeper for their timely preparation and delivery. The purpose of these disclosures is so that plan participants may cost compare and make rational investment choices. It would seem reasonable that plan sponsors would be meeting with or have vendors meeting with participants to review the investment fee information and have educational sessions. Moreover, if the plan sponsor has fee-related concerns, the plan sponsor really must understand that this is part of its fiduciary obligation. Next slide, please.
And Marcia, while we're going to the next slide here, and since you mentioned something that's heavily important regarding the benchmarks, I'm going to put a poll up there for the plan sponsors and for all of us to take a look at. But simple yes, no answer in terms of has your plan been benchmarked? Whether that's from the provider you're using or if you've used third-party benchmarking, but something that's important from the 408B2 rule changes that Marcia alluded to. We'll close that in a second, but I figure as we're going to the next slide, we'll take a look here. So I'll go ahead and close it here. And actually, I'm happy to say that 58% have had their plans benchmarked, and 42% have said that they have not. So we'll go into more depth in that in a minute, but I thought that was a good time to take a poll on where we're at while Marcia had mentioned the benchmarking here. So I will go here to the next slide.
Okay, thank you. Now what this next slide will deal with is a subject that causes more confusion than practically any other recently evolving subject in the area of ERISA. Therefore, I think we need to talk about an overview of the different types of advisors to pension plans. There are basically three types of investment advisors to plans with varying levels of responsibility under ERISA. They include non-fiduciary advisors, investment advice fiduciaries, also known as 321 fiduciaries, and investment managers, also referred to as 338 fiduciaries. Non-fiduciary advisors, an advisor that does not provide fiduciary investment advice, is not subject to the fiduciary standards of ERISA. Non-fiduciary advisors typically include broker-dealers with commission-based plan clients. As a broker-dealer, its investment recommendations are merely subject to the suitability standards under applicable securities, federal or state laws. An investment advice fiduciary, or 321 fiduciary, is any advisor that provides any fiduciary investment advice and is responsible for, thereby, furnishing non-conflicted investment advice prudently in accordance with the standards of ERISA. The term 321 fiduciary, therefore, would include providers of both discretionary and non-discretionary advice. 321 fiduciaries typically would include registered investment advisors, or RIAs, banks and trust companies, as well as other financial service firms. Investment managers, or 338 fiduciaries. Investment managers, by their very nature, must have discretionary authority to buy and to sell investments on behalf of the plan. A 338 fiduciary is a special type of 321 fiduciary, and the same types of advisors that serve as investment advice fiduciaries, such as RIAs, can also serve as investment managers. Now, from a plan sponsor's point of view, there would be a significant advantage to appointing a 338 fiduciary with discretionary authority over the plan's investment menu rather than engaging a 321 fiduciary to render investment recommendations. With regard to 321 fiduciaries, the plan sponsor is ultimately responsible and potentially liable for any and all investment acts or omissions committed, regardless of whether it's relying on the advice of the 321 fiduciary. With regard to 338 fiduciaries, once an investment manager is properly appointed by the plan sponsor, which would be the plan's named fiduciary with primary responsibility for managing the plan, the sponsor is no longer responsible for the investments under the investment manager's control. So long as the sponsor prudently selects the 338 fiduciary and monitors the 338 fiduciary, the sponsor is not responsible or liable for the day-to-day investment actions or omissions of the investment manager. Brad?
Yes. Actually, segueing into that, there's another question I'd like to pose to the group here, and this is going to be very interesting, especially what you just touched on, Marcia. I'm going to launch it now, but does your plan have a 321 or 338 fiduciary? Is it one that or is it something you know? I think that's an important topic, as I'll be taking the next 5-10 minutes here afterwards and going through to be able to see where we stand. But Marcia, I did have a question, stepping back a second while they're putting in their votes here. But regarding, are the standards of prudent disclosure applicable regardless as to whom pays for plan expenses?
That is an excellent question. Thank you for asking it. And it's a question that comes up, with increasing frequency. The answer is that if expenses are paid from, by, and through plan assets, i.e. if the plan is paying for the expenses, then all of the fiduciary rules, including the disclosure rules under ERISA, are applicable in full force. If, on the other hand, expenses are paid not with plan assets, for example, from the general corporate checking account of the plan sponsor, then the ERISA standards would not be applicable. ERISA only impacts, affects, and regulates, highly so, pension plans and their assets.
Great. Okay, that's good. I'm sure we may have some questions at the end regarding that, but that's something that we've definitely seen from plan sponsors, and we've answered it accordingly, as you mentioned, obviously, because you've advised us that way, and that's how we understand it. But I'm going to go and close this poll now, and we'll show the results here. Not shocking, and that's what I wanted to go over. What we're seeing here is actually, 19% have a 321 fiduciary, which again is investment advice, but not taking on discretion. Only 12% have 338, taking on that full role of partnering, as we would put it, and being able to delegate the roles and responsibilities of investment management to an advisor. And then the majority, and the lion's share, about 70%, 69 to be exact, says, I don't know. So it's pretty important for us to talk through here. But Marcia, great. Thank you for the notes there here, and that was exactly what we wanted to go over.
Oh, you're
I'm
welcome.
going to hide these results here, and I'm going to go ahead and touch base on a few things regarding what Marcia and Greg have spoken about, and really go over, what are the best ways to oversee your plan's retirement assets. Being that we are a 338, that special type of 321 fiduciary here at One Capital, it takes on a special role from current clients to really new clients, right? And what we mean by that is when we're talking with plan sponsors, administrators, we get the question a lot of, we really don't have a good understanding of how we're working this plan. Are we compliant? Who are we working with? And that's really having someone that's in your corner and helping you with that advice. So to the question is which is more suitable for my plan, it really tends to be what the plan is looking for, the size of the staff that's able to support it. Is it a big firm, small firm? So a lot of that comes in, and I'll talk about that in a second. But I'm going to show something real quickly again here. I'm going to show you the results of what we just pulled within the group here. Again, 69% saying they do not know if they're a 321 or 338, 12 saying that they're a 338, and 19 saying they're 321. What I've done here is I want to take a look at a study that was done regarding the entire retirement plan landscape. This was done in late 11 by Grant Thornton Drinker-Biddle. But what this shows is actually, of a plan sponsor study, 56%, so fair amount larger, good over half obviously is taking on needing investment advice, working with someone. However, end of the day, the plan sponsor is still taking on the fiduciary liabilities. I think this is important to see and know, because a lot of times what happens is when I speak with these clients and these advisors, they're going, really? I'm liable? This is what's going on? And that's why it's important for you guys to understand. Only about 14% in this poll, so actually not much difference between what we polled in our group here and what we're seeing in the industry, has a 338. This is still something that needs to be known, and a large part of why we wanted to discuss this on the webinar is it's an important facet, along with being an administrator on plan, but also with the rule changes happening about six months ago or so now. It's important for us to take note of it. The non-fiduciary advisor and non-fiduciary advisor / internal governance is something I'll go over here in a second. But that really is, in an essence, a smaller portion in the event that we're going to design a team internally within our company that's going to manage the assets or be responsible for this and choosing and selecting the pertinent investment advisors. And a lot of times what I hear, and sometimes what I speak about on panels or webinars and such is, we all do what we do best, right? If in a manufacturing company, a distributing company, or a law firm, or however it breaks down, typically that role in that company is specific to what you do best, and a large part of it is partnering. And that's why we see a smaller percentage of them actually taking on what they do in their day job, as well as managing the retirement plan. So let's talk about that section here for a second, though. The internal governance here, really what that means in the non-fiduciary advisor type is again, back to what Marcia had mentioned on non-fiduciary advisor. How that really shakes down in essence is the broker is subject to suitability standards, right? So typically it's a BD or commission-related products. We had a pretty large shakeup in the retirement space last year. Hartford, one of the main providers, actually sold their retirement plan business. And there's some speculation leading up to why that is. But regardless, that's the typical commissional products we see out there, and that landscape, from our perspective, we see changing. We see more of an active role from an advisor, and I employ the plan sponsors and administrators to find that, to ask for that, because it's something that's out there, it's needed, and it can be reviewed and complied with by firms such as Miller Kaplan and Rossi and Wagner Law Group. So really what this is, they're retaining the entire discretion on their plans. They take on the fiduciary responsibility, and they retain the role to select and monitor the managers, right? They're internal. Now, one of the stats here this is a SSGA Investment Solutions Group poll that we pulled that kind of shows, again, reiterating the small amount of actual plans or funds that use this type of non-fiduciary advisor, or to some extent internal governance or internally doing this. You'll notice that of those, the public funds and state funds and corporate plans, typically, in my experience, these are very large corporations and large endowment funds because they have an average size of 7 to 15 people that are solely focused on this. Those of our clients and those of the people on the call may see that as a benefit, which it absolutely can be. It depends on the time and approach and what you want to be doing it for. Going into the 321 fiduciary, this is the typical, again, back to the majority or the lion's share of the plans that are out there that we're seeing. And another Greenwich Associates study even proves more to that point. We're seeing 83% of corporate plans, 84% of public plans, and about 85% of endowments and foundations using a 321 fiduciary. Basically, they're employing a advisor to help them select and monitor investments, but at the end of the day, they're still retaining the fiduciary responsibility, something that Marcia had mentioned that plan sponsors need to be aware of. So should there be an issue or with a hardship withdrawal or something that goes on with the plan sponsor is liable. Now, those of us on the call that know that there's bonding involved, Fidelity bonds and Arista bonds that are out there, that's there for a reason, and most of them are required, right? But those tend to play into the space that it's still something that you guys should know and understand. And again, I hear it a lot and see it a lot that's going, really? I didn't understand that. I thought that's what we're using the advisor for. That's why it's important for us to bring up what a 338 fiduciary is and what it really means to each one of you. On that note here, 338 fiduciary, in a sense, is a special type of 321 and encompasses both, as Marcia had talked about. What it really entails is it allows the plan sponsor to not only oversee the advisor, which they are doing anyways, but that's their sole responsibility. So if we are able to shed the liability and the fiduciary responsibility, something that the plan sponsors thought they already had, it really is a nice, seamless way to say, look, not only are we going to select and prudently manage your retirement plans after we understand exactly the goals and ideas that are needed for the plan and its participants, we also take on the discretion to help let you do what you guys do best, and we'll partner together with you guys to make sure that we are doing what we do best. And that's and by we, I mean 338 fiduciaries, One Capitals of the like. So it's something to be seen. And I actually pulled a couple of things that were very important stats out there that I thought was pretty interesting. 90% of chief financial officers saying that partnering or having a 338 fiduciary of non-core functions, again, back to the point being non-core functions of, managing a retirement plan versus, or anything that would impede or time taken away from doing your daily role, right? It actually increases shareholder value. So those companies that are private or have internal stocks or even ones that are public, that's an important thing to understand. We're actually, the market's predicting 13% compound annualized growth for this 338 role through the institutional market here through 2015. Now, to date, this gain has not been seen in the defined contribution, so the 401k space. We're seeing it a little bit more in the defined benefit space, the pensions and such, which is good. But the more advocacy that's going out there, something that we're trying to get across here with One Capital, Miller Kaplan and Rossi, and Wagner Law Group, we want to make sure each of plan sponsors, administrators, and the like understand and know that this is something that's out there, something that's important to know, and that it's going to be a rising market here that's going to be able to protect the plan and hopefully better serve it in the goals and strategies the plan wants to employ. One of the things here, and it's kind of reiterating what we've already gone over, but only 7% of corporate plans, this is again another study here, but 7% of corporate plans, 3% of public plans and endowments are actually utilizing a 321 and 338 investment manager. So we've shown 3 different studies. All of them, the highest we've seen with our internally, we had 12% say they're 338. We had one study say that of their market research, they had 14%. This one was another one that says only 7% of corporate plans are actually using 338. Now, oddly enough, when I'm speaking with those corporate plans or when we talk with them, oddly enough, they actually feel that sometimes the added advantages of 338 are actually already being had as a 321. So it's less of a, why don't I have that? It's more of a, I thought that's what I had. This, and going back to the advisor, and again, please, I implore you to speak with them and ask for this because it's there and it's important. So we're going to go over some questions here in a second, but I wanted to make sure we touch base and walk through that and show some market research behind it. But one of the things, too, that we wanted to provide for each one of you, and Greg's going to talk about it in a second, is a benchmark study. Marcia had alluded to it during her discussion, something that's for those of the plans that are passing along the cost to the participants. This is something that's required now for the overall rule change. We're getting a benchmark, and those of the ones that had said they hadn't got the benchmarks, I implore you to, and we want to make sure we help you with that. So we're providing a free benchmark here, a complimentary one, if you guys all want to log into that, and Greg will take it from here and close this out. But Greg, please.
Well, thank you, Brad. Let's see, did any questions trickle in the meantime from any of the participants?
We do. We have one question. Will the slides be available to print later? So for everyone, what we will do is we'll be sending an email out with the slides in a PDF form for you to go over, as well as you'll be receiving the audio recording of this as well. Within that, you'll have our contact information for us to go through as well, should you need to reach out to Greg or Marsha or myself.
Yeah. Okay. Well, as we come to the conclusion of our webinar, we want to thank everybody for tuning in today. And we hope that you found today's webinar useful. And as we shared with you some important developments in operations of your 401k plan. Speaking of one of those areas we talked about, as Brad had touched on, is the benchmark study. And you'll see up on your screen a form for you to fill out with some information, and it will allow you and your plan to get a complimentary, no obligation benchmarking study for your 401k plan. So fill that out, and should you take the opportunity to do so, and after you receive your benchmarking study, if you have any further questions on it, please don't hesitate to contact either myself or Brad or Marcia, and we will be happy to discuss those with you. So again, it looks like there's no more questions that have trickled in, so we want to take this opportunity again to say thank you to everyone for tuning in, and have a great day, and we'll talk to you all soon. Take care now. Bye-bye.
Bye. Thank you.